Before you make a mistake, watch this for rebalancing.
Brian, I am super excited about this because I feel like this is one of those shows where we get to flex a little bit. We get to talk about some of the, not flex like that. This is some of the things where we get to talk about something that is a little bit more intricate, that's a little bit more nerdy, that's a little bit deeper in the weeds when it comes to like financial planning and investment management, but we think is wildly valuable when it comes to navigating your overall financial life.
Well, I think about terms that people who start showing an interest in personal finance, they hear, but how often do people just not tell them how do you actually do it, or what's the value, what's the purpose? It's like, this is the perfect concept and content to kind of go over, because we hear terms like rebalancing. But does anybody ever tell you what that actually does for your portfolio? How does that add value to your long-term future self? We're going to dig into that, just like we did the tax loss harvesting show probably 4 or 5 months ago. And you guys, I was like, is this too nerdy? And you guys told us, no, this is great. This is what you want. This is classic money guy content. So we decided we flex, as Bo said, because he loves flexing. Then we'd bring in the content and talk about rebalancing.
So with that, let's do a really quick like Webster definition vocabulary term. What is rebalancing? Well, it is simply the process of readjusting your portfolio back to its intended allocation. And this is necessary because assets grow and change at different rates. So without it, one's portfolio may not match their overall goals or their overall risk tolerance, risk capacity. So it's necessary to keep your assets where they are supposed to be, not out there sort of floating in the wind.
So that's a great definition, but that doesn't, if I was trying to get a little more introduction to why do we actually rebalance, I wanted to we broke this actually into the reasons you would rebalance. And the first one was implementing changes to your investment objectives. Now that sounds like a very fancy textbook type definition. What does that actually mean, Bo?
It's really interesting, Brian. We were talking about this in show prep. Like, what's a really good way to lay this out? And when you think about investing, most folks who come to investing, we said really have sort of two goals, right? Your goal is either to get rich, to build wealth, to become wealthy, or if you've already accomplished that, your goal is to stay wealthy. And the answer to where you fall on that will affect the way that you allocate your portfolio and ultimately why you rebalance and how you rebalance through time.
So let me put some numbers on this to kind of give people some context. When you're in your 20s and you have not a lot of resources because you're just starting the journey of building wealth, it's not uncommon that you might have 80 to even 90% of your money working on get wealthy.
Build wealth.
Only 10% of it is probably at the stay wealthy or not be poor, because you're all about the being aggressive to reach your goal. Because what do you have to lose? I mean, because typically if you're starting from zero, you can be super aggressive because you have not much to lose and you have lots of time to let it kind of absorb and work through there. But keep in mind, getting wealthy versus staying wealthy think about the person who's actually reached a level of success. You guys know I share this data point all the time. I was talking to my daughter about this. You're like, man, what a weird father that this is what you talk about at Cracker Barrel with your daughter. But I was talking to her about how it's so unfortunate that the stat of 70% of wealth, meaning millionaires, 70% of it disintegrates in the second generation, meaning the kids of the millionaires, 90% by third generation, meaning the grandkids of the millionaire. Typically, it's gone. The process completely recycles. So there is a change in your mindset that should happen once you build wealth. Figure out where's enough. Where is let's change the allocation to where now when I'm in my 60s or 70s, it might be 70% of my portfolio needs to reflect stay wealthy, or meaning not be poor, versus 30% is going to be get wealthy, because that's the part that's hopefully going to work and get you through retirement by still growing in the background. Pay attention to those things. They're two different objectives, and they work differently in your portfolio.
And so what's interesting is as that goal shifts from just getting wealthy to figuring out how to stay wealthy, what most often happens for us is that our appetite for risk changes. While we're in that I really want to get wealthy phase, I have a high tolerance for risk. I want to be aggressive. I want my portfolio to be out there. But as I begin approaching retirement, my appetite for risks begins to decline. And as I get into retirement, it drops even more. And then once I'm in retirement, once I'm living off of these dollars, I care less about how much my portfolio is going up and down and how much it's growing. And I care more about the stability of the value of the portfolio. So as you move through moving in those two goals, I want to get wealthy, I want to stay wealthy, our appetite, the way that we want to approach risk naturally changes. Well, inside of our portfolio, we have to make sure that that's reflected.
Yeah, and it also impacts your stage of life. I mean, this shows it in a lot of ways, and we could have easily put ages underneath this as well, is because I know when you're in your 20s, you're kind of in that gladiator phase of your life where you want to conquer the world, you can take those risks because your risk tolerance can be extra large. Meanwhile, you get a little bit older, a little more wisdom under you, and you've built some assets up. It's not uncommon, especially post 40, where you're no longer in that gladiator conquer the world. You're kind of thinking about, you're much more of a thinker. There's more wisdom there, and that mellows you out. Your portfolio should reflect that as well.
And so what we do is rebalancing allows a natural mechanism for us to do this. Now, you've probably heard us talk about this a lot, but we love target date retirement funds, target date index funds, because they paint a very clear picture of what should naturally happen in your portfolio. We went and pulled some sample glide paths. Now, these are from age 20 to age 75 based on the Schwab target retirement indices. And you can see for someone who's 20, it is a heavy equity allocation. It is going to be very, very aggressive. But as someone moves along their life cycle, as they get closer to age 55, 60, 65, 70, their appetite for risk decreases. So the amount of risk inside of their portfolio should decrease. Now, some of the people in the chat, Brian, are already saying, hey, but just because you're retired doesn't mean you should be completely conservative. Doesn't mean that you should take all the risk off the table. And that's entirely true. However, we would argue that a retiree living off of their portfolio should have a portfolio that looks different than someone who's just starting out in their career. And the way that you get from one point to another is through this process that we call systematic rebalancing.
Yeah, and it's going to change. And I love that we're going to share the tool that helps make this glide path more possible. I mean, it actually gives a process or procedure where you're not just stuck with the same asset allocation when you're starting at age 23 all the way through 65. By the way, if you want to impress when you go to the next party, just be like, oh, yes, I love target retirement index fund varieties because have you seen their glide path? You're going to be so impressed because they're going to be like, glide path? That's the coolest word I've ever heard. So now you've heard it. We didn't give you the definition because we wanted to first kind of hook you, see the visual of this, what is a glide path, but it does tie back, and Bo's exactly right. We love these index target retirement funds because really you only have to do two things while you're in the beginning of your journey. How much can I save? When do I need it? I don't have to focus any calories from my mind on anything else while I'm in the building process. Now, in a minute, we're going to share why this changes later as you get to more wealth, you reach a critical mass or that bowling point that I talk about. You don't have to do that while you're in the beginning. Just think about focus on what you can save, when you need it. Let the rest of this just be an education that you'll use at a later point.
No, I think it's important to mention you and I go to very different parties. We just go to very, very different parties.
Well, that's because you're in the gladiator parties. Y'all are trying to figure out how you're going to storm the next fort or take over something. I'm in that wisdom element of my life where we are talking about
glide path is the topic of conversation. So,
exactly right.
So obviously, why do we rebalance? One is to navigate those changing investment objectives, to move from the I want to get rich to I want to stay wealthy phase. Another reason that we rebalance, another value that it can add to your portfolio is it allows you to tax manage your portfolio. We all know that one of the things that's a certainty that none of us can avoid is the fact that we will experience taxation, especially in this country. We know that we're going to have to pay taxes. I think it was probably Benjamin Franklin who said there's only two things that are certain, right? Death and taxes. So if it is a certainty, if it's something that we know that we're going to deal with, we want to make sure as we think about rebalancing, is there a way, is there a mechanism that we can do so that will help us from a tax standpoint?
Well, the cool thing about the Money Guy Show is we love to give case studies. So, why I tell people that this is powerful for rebalancing for tax purposes, it's easier if you actually have an illustration to see how this works. And Bo, I loved Daniel did this. He was trying to throw a little bit towards your way, but 2 birds, 1 stone.
2 birds, 1 stone. So think about this. Let's say that Tim is an investor and he has $200,000 in a taxable investment account. So there's going to be some natural tax drag associated with that. Let's say that the target allocation in this account is 50% S&P 500 and 50% international. So this is an all equity portfolio, or $100,000 invested in each of those, right? Well, let's assume that we go through a year like 2022, where maybe the market was not as strong and the S&P 500 loses 20% and the international fund loses 30%. So now, instead of having a $200,000 account, Tim is down to a $150,000 account. And instead of him being 50-50 allocated, he has 47% in his international holdings and 53% in his S&P 500. You would argue that he is out of balance and he likely needs to, quote unquote, rebalance his portfolio. Anything you'd add to that?
Well, I think it's interesting because we are, without meaning to, we did this in financial mutant fashion because the easy way to rebalance this is to look at your U.S. stocks, your international, take them right back to the same allocation. But the problem is, if you just did it in that simple way, it would only generate about $1,500 of taxable losses that you'd be able to recoup. Now, I've already hinted at this at the intro of the show. If you combined this rebalancing strategy with tax loss harvesting, where you bought something that was similar but not the same, so that it actually passes the IRS rules, you could actually use this opportunity of tax rebalancing to generate a huge tax savings.
Yeah, that's right. Instead of selling 5,000 of one holding and buying 5,000 of the other, you're saying he could sell the entire account. He could sell all of both of them, buy into something similar but not identical, and he's going to have a huge loss benefit that he's going to be able to use both this year as well as many years into the future. So rebalancing can be a great thing that not only allows us to tie ourselves to our overall investment goals and objectives, but it can be something that we utilize, especially in years like last year, to help us save on taxes.
Because it lets us pull in another financial tool like the tax loss harvesting. And I was going to say, because a lot of people would be like, you guys are optimists. Why would you bring up a pessimistic thing like a bear market and the market being down 20%? Let me tell you the other side. When things are good, and this is why I love when you bring these financial tools together, when markets are good and you're up now 20 or 30%, you could combine rebalancing with not only the loss harvest that you did back during the bear market, because some of those best performing months are right after the bear market, and you get into that first beginning part of the bull market. You could pair that with charitable giving.
That's right.
Because you can give appreciated holdings to your favorite charity. You can then, because you probably set that basis much lower, as long as you held it for a year, it's a huge tax benefit. This is the way I've told you guys, when I give to charities, I love giving appreciated holdings. I love tax loss harvesting. And if you're looking at the when component, when do you actually do this? Use rebalancing as kind of that trigger point, because you're going to be consistent. You're going to have a period of time that you're looking at this, and it's going to, prompt the action that makes all this possible.
Again, when we think about our financial lives and being a financial mutant and building financial security is really a combination of a lot of little small tasks. It's small tasks that we end up adding up over time. What I think is amazing is most people think about rebalancing and it's strictly an investment thing. Oh, okay, rebalancing investment. Here we are doing an entire section talking about, well, really rebalancing not only can affect your investment portfolio, but it can also affect your taxes. And if you can frame your mind to think about it that way, you'll be amazed at how much these small changes can have a huge impact later on in your financial life.
Yeah, you get to stack these things. I love that. If you can just change little things in your behavior, you will get big results in the long term. Hey, it's almost like we're talking about compounding.
That's right.
That's always something that we work on here. Let's talk about number 3. The third reason why we rebalance is to adjust for the changing financial world we live in.
Now, I want to be very clear. This is not market timing. When we say adjust to the changing financial world, we're not saying, oh, I got to rebalance and I got to go from all equities and now I got to go to all conservative investments, or I got to go from all conservative to all equities. Remember, when we move through our life cycle of investing, it is a glide path, not a glide cliff. So if you find someone who's constantly flipping your portfolio back between an 80-20 portfolio to a 20-80 portfolio, or I'm going to cash and then I'm getting out of cash, I would argue that you're not really rebalancing. You're not using it as an investment tool. You're more timing the market. And the studies would suggest to us you're not likely setting yourself up for success over the long term.
But let's actually give some illustrations here. I want to talk about what are some of the big macro things that we're talking about. Something that comes right to mind, Bo, interest rates. I mean, one of the big, the harder things to do as a professional financial advisor and asset allocator for our clients for the last really 10 to 15 years is that we've had historically low interest rates. The problem with taking cash to pretty much zero to stimulate the economy is that anybody who's approaching into retirement, the only way you can capture, you can't get yield from buying cash. Bonds, the yield's not there. The only way you could really try to capture a good long-term return was really go more out on your risk spectrum and still asset allocate, but you are going a little further out there than you have historically to capture return that you could then spend during retirement. Fortunately, this is one of those silver lining moments, lemons turning into lemonade, is when interest rates have been pushed up so rapidly to fight inflation. Now it's not uncommon. Your cash and your bonds and other things can get historic reasonable rates of returns again. Now you can get over 4% on your cash. It's not uncommon bonds to get back to 5-6% rate of return without taking a lot of risk. This allows you much more balance on your asset allocation. So you have to pay attention to those big macro events, because if you're not paying attention, you wouldn't realize, hey, maybe this is the time to rebalance and adjust for some of these changing things like higher interest rates.
Interest rates are a great example. Another really interesting example are just valuations within market cycles. It's not uncommon. Maybe we just came through a large downturn and maybe interest rates are low, and you start thinking to yourself, you know what, in a low interest rate environment where the cost of capital is low, but the economy is looking to improve, maybe instead of having a lot of my portfolio in large U.S. companies, I think that small U.S. companies might outperform coming out of this bear market. If you have that position, and if you think that's something that could take place, rebalancing provides a mechanism where you can take advantage of that, where you can look at price to earnings ratios. Where are we in the bear market? Where are we in the bull market? How do I factor in yield in my portfolio versus capital appreciation? Rebalancing systematically gives you an automatic time where you can look at these things and take advantage of these things as they present themselves inside of your portfolio.
Well, I mean, one that I always kind of perk up to when I'm looking at it is there have been times in the last 15, 20 years where you could compare the 10-year treasury to what the dividend yield of the S&P 500 is. When those things are getting really close to each other, you're like, what? You pay attention to that. It doesn't mean, as Bo said, your glide path, not a glide cliff, but it is something you should be in tune with what's going on out there in the macro economy, so you can know what that means for your asset allocation. It's just one more indicator, and you can use rebalancing to be that trigger point to pull in another financial tool to make your investment journey better.
Another thing it allows you to do is look at big macro events like geopolitical events, whether that be international conflict or things going on in other countries that could impact your portfolio. Again, this is not a mechanism to time the market or to try to make rapid movements, but if you are systematically rebalancing, you can make sure that your portfolio doesn't get completely out of whack. Over the last decade or so, it's been not uncommon that U.S. domestic markets have outperformed international. Well, if you had a domestic and international portfolio and you did not rebalance, you're probably way overweighted domestic right now and way underweighted international. Rebalancing allows you to better make sure your portfolio ties to where you want it to be over the long term. It allows you to keep an eye on those other things going on that could impact your ultimate rate of return.
But Bo, I don't know if we're just lucky or if we actually planned it, but that is a perfect segue into, you hear people all the time share the concept, man, when you invest, here's a key tenet that you need to get right. Buy low, sell high.
Yep.
That sounds so easy.
Sounds easy.
It just, I mean, we had one of our early TikTok React videos. One of the biggest reactions we got was there's this couple, and bless their heart, but that's what they said. All you have to do is you buy here, you watch the visual, and then you sell it after it's gone up a little bit, and then that's it. You can quit your day job and do it. It sounds that simple it does, but that's not the way we all, from an emotional standpoint, from a market cycle, from an economic, it just is not that easy unless you have something that forces your hand and triggers you to actually look at your winners and losers and rebalance.
But so what's great about that, Brian, is that naturally leads to this next question, right? You may be thinking, all right, rebalancing sounds great in practice. I understand the academia of it, but wouldn't it hurt me? I mean, if what I'm ultimately doing when I'm rebalancing is I'm selling the things that are doing well and I'm buying the things that have not done as well, wouldn't this hurt my overall performance? Wouldn't I be better off doing nothing? Well, fortunately, here at the Money Guy Show, we like to show you the numbers. We like to dive in. So we actually had Daniel put together some analytics around this.
Yeah, this is great. By the way, we had a concept. We're like, I wonder, because I want to prove to our audience that what we share is not just lip service. So let's actually show them some data. And when this illustration came back, we were like, man, this is why I love what we do for a living. So, Bo, I don't want to steal your thunder. Walk them through, because when I first saw this chart, I was like, man, those lines look so similar, but give them the full context.
Yeah, so what we're looking at here, we're looking at two 60-40 portfolios. It started in the year 2000. We're looking back over the last 22 years of investing, and what you can see is that one of the portfolios, the dark line, is rebalanced annually. 60-40 taken back to 60-40 on an annual basis. The lighter green line is never rebalanced. And so this thought of, okay, what I'm going to do is I just want to make sure that or if I'm going to rebalance, isn't going to hurt my long-term performance. What you can see is over this 22-year time period, through which we saw the dot-com bubble burst, we saw the Great Recession, we saw COVID, we saw 2022, and then we saw a lot of really positive bull markets in there as well. The overall difference isn't that huge, right? You look at a total return performance of 264% relative to 268% total return. And so you start thinking, then what,
is this a must do about nothing?
Why
it seems like a lot of calories spent. The other thing I thought was interesting, because I know we have podcast listeners who don't get to see all of our visuals, is that if you look at, when I look at this chart, I see, man, from the get-go, it looks like in most economic cycles, the never rebalancing underperformed rebalancing. So that's good. You're like, hey, I expend the calories, I'm making more money, I'm more active. That's a good thing. But then recently, because we've had such a huge run-up of the S&P 500, really post-Great Recession, it's been a rocket ship up. And you can see that, yes, maybe you should just keep your winners forever, but it's actually settling back down because we've gone through this bear market of 2022, that there really is only a 4% difference. So does that mean that we're doing content that doesn't really move the needle, Bo?
That's what it seems like, right? On the cuff. But let's, again, think about this in practical terms. Again, we're talking about 60-40 portfolios, and this is just 60% S&P 500, 40% U.S. Treasury. Very simplified asset allocations. Well, let's think about two retirees. Let's think about Trina and Tina. And let's say that they retired in the year 2000 with $1 million invested, and they were going to target a 60-40 portfolio over their retirement life cycle. And they're both living off of these monies, and they listen to Money Guy content, and so they say, you know what, a 4% withdrawal rate should be sustainable over the long term, so we're going to live off of $40,000 a year. We have $1 million portfolio, we're going to pull off $40,000 per year, or 4% in retirement, but we're going to behave slightly differently. Trina is going to rebalance once per year. She's going to do the annual rebalancing, but Tina is never going to rebalance. She says, I don't think it makes that big of a difference. The numbers don't look that different. How does this play out? Well, when you actually look at the dollars of this scenario, it makes a pretty big difference. Look, after just 2 years of living off of these dollars, on July of 2002, that's kind of the bottom-ish of the dot-com bubble bursting, you can see that Tina has a balance of about $650,000 in her portfolio, where Trina has $740,000. That's over $100,000 difference which I gotta believe living through that, you're thinking, oh man, I'm getting nervous. That 4% withdrawal rate that I did have is now much higher than it was when I started my retirement.
Well, I love that it creates a trigger point. Think about this. If you're trying to figure out why does one have a better alpha than the other, I love when you do rebalancing. Now, we ran this through Y charts, so it's not even using the human component of make sure I get my winners versus the losers on the buy low, sell high. This is just making it a systematic process.
Yep.
I think the difference actually is bigger in reality is because this does allow you when you are pulling money out of your portfolio, you're saying, hey, I don't want to sell this stock while it's down 25%. You know, I want to kind of, I'll pull off my more conservative stuff and then I'll be opportunistic. There's actually an alpha component above and beyond what we're even showing here. So it blows my mind that just 2 years into this, we already have such a big variation in this. I can't wait to see where the rest of this illustration goes.
Yeah, so let's fast forward to the next scary time, the Great Recession. If we look at the value of these two portfolios on March 9th of 2009, Trina now has a $640,000 portfolio. Tina is only at about a $512,000 portfolio. Now remember, they're still pulling off $40,000 a year. So what was a 4% rate of withdrawal for Tina has now doubled to almost an 8% withdrawal rate. Again, in real life, when that happens, you got to start getting really, really nervous, thinking, holy cow, I've only got $500,000. I'm pulling off $40,000. Man, I wish I had that extra $130,000 that Trina has in her portfolio.
So rebalancing is pulling away here. I mean, it was less than $100,000 difference after 2 years, but you fast forward through this, now we're at $130,000. You can see you are being rewarded for pulling in this tool that makes you actually have action on settling out and rebalancing the portfolio.
Now,
that's powerful stuff.
Now let's look at the end. Let's look all the way now as of end of last year, 12/31/2022. Tina's portfolio has grown. It's been a positive market. She has about $1.27 million inside of her portfolio. However, Trina, who is rebalancing annually, sticking to a system, taking advantage, making sure that her portfolio matches her goals, has a portfolio over $1.5 million. That's almost $250,000 difference just by rebalancing on an annual basis.
Bringing this back to, we showed you that there's, if you put them next to each other, one rebalancing every year, one just absolutely doing nothing, letting the winners run. We saw there was only a 4% difference between the two. So that shows us, and this is taking the path that Bo was talking about, you don't get penalized for clipping some of those winners. I think a lot of people will say, man, because trees don't grow to heaven. Right. That's something, this is why this strategy works. You couple that with somebody who's pulling money out, and you can see this is dramatically different. And it's all back to your statement you said earlier. Small changes, small differences can have dramatic and big rewards for you in the future. This is why we tell people start saving young. This is why we tell you be active with your financial decisions, is because every small decision you make, you're stacking that with other small decisions. Yep. And then you get time, that component out there in the future. And we're like, whoa, these are two different paths. The same things happen with your friends and your family. They go, why does he or she have resources and I'm broke? It's because all these things are stacking on top of each other. Pay attention to these deep dives, because this can be something that's a skill set that will serve you well over the long term.
Okay, Brian, so we've talked about what rebalancing is, and we've talked about why we do it and some of the benefits of it and some of the big impact it can have. But here's the big question that everybody wants to know. Okay, I'm sold. You got me. I'm in. But how do I do it? How do I go about rebalancing? What are the things I need to know if I want to make sure that I'm systematically and consistently rebalancing my portfolio?
But everybody's going to have questions.
Sure.
And let's go ahead and just knock these out. The first one is, how often should I do it?
Yeah, it's a great one.
And look, I'll tell you, in the content meeting, we were talking about, like, man, is this something you should do daily? Is this something you should do weekly, monthly, quarterly, annually? Where's the actual perfect ideal point? Because I do think that there is as a former tax preparer, you guys know I did tax preparation for 16 years as part of my journey of becoming a financial advisor and growing this practice, is that you can do too much of a good thing, because the people who are day trading, anybody who's ever had a client who's a day trader, if you were rebalancing on a daily basis, I think the transactions, the cost, the tax compliance, it's just too much. So I'm just going to go ahead and tell you, I think that daily, weekly, that gets a little scary.
Sure.
Now, I think the big thing when you're talking about monthly, quarterly, and annually, the big thing is, are you consistent?
That's it. Nailed it.
If you are consistent with your behavior, I think that somewhere between those three, as long as you are making sure the behavior is occurring, is where you need to live.
No, I think it's interesting, and we'll talk about this in a moment. There's a difference in looking at a rebalance and actually rebalancing. So you may say, you know what, I'm going to look at rebalancing twice a year. What that doesn't mean is that you're actually going to place trades twice a year, because then you have to answer the next question. What triggers a rebalance? How will I know when it does make sense for me to get back to target? Is it going to be a time period thing? Like every 6 months I'm going to place a trade? Am I going to add some tolerance bands saying, okay, I know that I want to be 50% allocated here, but if it goes to 45, I'm going to buy more. If it goes to 55, I'm going to sell some. Or is it just going to be something that I have it, set it and forget it, automatically I'm going to just go back to the 60-40 every year, one time, click a button? You have to answer that question for you, is what does trigger rebalance? Now, we already talked to you about there are some planning things you can do, like loss harvesting, charitable giving. We didn't even talk about capital gain avoidance, which is another huge planning thing you can do at the end of the year every year to save on your taxes. Maybe it's event driven, but you have to answer that question. How often do I do it? And then how do I know when I'm actually going to pull the trigger and start moving money around?
Well, and you make a great point, because we look, a lot of you guys who are clients, you came to us because you watch Money Got content. I don't want any of you guys watching this to be like, hey, how do I, because I don't see on my quarterly reports that you guys are pulling the trigger every month to rebalance. And that's why, and some of you have asked about this in the past, and we were like, every quarter, we are definitely reviewing the asset allocation, but it doesn't mean that we're actually pulling the trigger every quarter, because sometimes there is slight variation. This leads to the third point that we were talking about, is all rebalancing treated equally? Now, if you're investing 3 to 4% in an asset class, and it is now 1 to 2% different, now you're talking about this could easily be a 30 to 40% spread. That is probably something you should talk about.
Big deal, big change.
Versus, let's take something like a large cap S&P 500, which might be 45 to 55% of your portfolio. Is it that big of a deal that you've got drift to 56 or 57%? I would tell you, from a materiality standpoint, it's a much smaller threshold. So you need to be consistent, but you also don't need to be so over the top that you're getting busy doing nothing when it's not adding a lot of value.
Okay, great. So I can answer these questions, but now I want to think about practically, in practice, how do I think about doing this? And I know that technology has made it easier to be an investor. Technology is something that has been a huge boon in the financial world. And so now I know that there are actually things I can do or have a robot do it. I can actually pay a service, and I can just set up, and I don't have to think about it. I can just tell it what to do, and I can have a robo rebalance or a robo advisor doing that. Is that the solution? Is that a solution I should do?
We all know. I'm the biggest kid in the room. I might be the older person here, but I'm definitely the biggest kid, so I love the childhood fables. And you think about Goldilocks and the Three Bears, and her poor journey to find the right fitting chair, bed, and of course the right porridge. And you're hoping you do find that also with rebalancing, because I want to go through a fable for you in the investment world. Let's talk about first the robo-advisors. You brought the machines in. Everybody seems to be talking about all the machines and how they're going to replace us humans. But here's what I know about the machines. When I look at all these robo-advisors that came on the scene and they start marketing off of, we are rebalancing, I don't know if they're telling you the daily, the weekly, they're talking about the tax loss harvesting. Being a former tax preparer, I can tell you they do it too much. If I'm the Goldilocks, I'm like, ooh, that is too much, because they send you these 1099s at the end of the year, and you're like, that is a lot of accounting I'm going to have to take advantage of. And I don't know if there's a lot of alpha just from being driven to that activity. So if we say that that's too much, Goldilocks is going to go to the next bowl of porridge, and she's going to taste it. And this is the do-it-yourselfer. And look, there's a lot of you guys, because we give away tons of free content, and you're going to say, well, I'll just do this myself. And I think that's great. I want to invite you on the journey. First, we always tell you, look at those index target retirement funds, because they just take this out of your control.
That's right.
You focus on how much you can save when you need it. But those of you who are beyond that point, but you're still a do-it-yourselfer, you're thinking, I'll do this myself. There's research that shows you might intend to do it, but unfortunately, according to this article that we found, hidden retirement risk, 85% of workers aren't rebalancing their 401k. So you might have the intent, but the do is somehow being avoided.
Well, it makes sense. We all get busy, right? We all think, you know what, okay, I'm going to start investing. I'm going to take this seriously. New Year's resolution, I'm going to be active in my portfolio. And then the kids things happen, and then the job thing happens, and then the church thing happens, and then all of a sudden you're pulled in 1,000 different directions, and it's November, and you're like, holy cow, I haven't even looked at my portfolio at all this year, and we just don't do it. And so you fall into one of those case studies where that portfolio, that 60-40 that you thought you had, isn't really a 60-40 anymore, because it is so easy for us to let the financial things in our life that aren't on fire just fall to the back burner. And unfortunately, rebalancing usually isn't a thing that's on fire for most investors. It's something that's an afterthought, sort of in the back of the mind, not paid a lot of attention to, so it just falls off.
So we've already got doing it too much, doing it too little. The Goldilocks just right, of course, leads back to the abundance cycle. Why not bring in somebody on the professional side so that they are paid in a very reasonable way to make sure that you're consistently rebalancing, that you're consistently taking this into account in your overall tax plan, that you're consistently implementing this when it comes to your charitable giving goals and all the other things that are playing into your retirement dates. All this stuff gets complicated. As I've shared with you guys many, many times, we can give away so much free advice because I know the desire for humans is we want our lives to be simple. And we want to set it, forget it, and create automatic, inevitable wealth. But the reality is once you do create that inevitable wealth, your life gets complicated.
That's right.
And that's why I can get you there. I can invest in you. I can just share the abundance cycles, because just naturally the cycle is going to make your life complicated. And then you'll remember who planted the seeds. And that's why this is paid off. And that's why we work with people all across the country. So if you love what you've heard here and you're like, man, I like financial advisors that are willing to get their hands dirty and actually get into the depths of what happens with tax planning, how this all plays into my glide path for retirement, how I'm going to pull this into withdrawal strategies. That's what we do. We are not the sales folks. You know, when people go to parties and they say, hey, what do you do for a living? I always cringe when I want to say, I'm a financial planner, because they're like, is he going to whip out a life insurance policy or is he going to try to
sell me something?
No, I love just answering questions. I think you guys can tell we have built an entire platform because we're technicians. Everyone who works here, I did a studio tour yesterday, Bo, and there was a couple and their clients, and they're like, man, your guys, they are loading me up. I mean, they are doing so good. I mean, it made my heart just want to sing. I wish if my heart could sing better than my voice, we'd be, there's a reason we live in Nashville. I might be famous for that. But it is one of those things where it makes me so happy. We love working with clients. I would encourage you, Bo, if you're early in the journey, keep subscribing.
Yep,
we love giving away free content. We don't even mind if it takes you 10 years to get to that level of success that you need us. Just keep on taking the free stuff. We don't mind. If you want to accelerate, you can always go to moneyguy.com/resources to get the free deliverables. If you want to even take it into the fast lane or spring your finances even faster, go check out our courses at learn.moneyguy.com. We have something for everyone. It's very deliberate because we want to reach you where you need to be reached so you can start stacking those small decisions that are going to have a huge impact in your future self. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy team, rebalanced out.